The war in Iran, a systemic shock to global financial markets. Introduction, a global shock. What if a war thousands of kilometers away could reshape your economy, your investments, and the future of global markets? The conflict involving Iran is no longer just a regional geopolitical event. It has evolved into a systemic shock, one that is sending ripples across financial systems, energy markets, and investment strategies worldwide. In today's interconnected world, no economy operates in isolation. A disruption in one strategic region can trigger a chain reaction across continents. That is exactly what we are witnessing. From stock market volatility to soaring energy prices, from inflationary pressure to capital flight, the consequences are not theoretical, they are already unfolding. Understanding these dynamics is no longer optional. It is essential. Part 1. When markets lose visibility. Financial markets thrive on predictability. Investors allocate capital based on expectations, growth forecasts, earnings projections, and macroeconomic stability. But war destroys visibility. Since the escalation of tensions involving Iran, global markets have entered a phase of heightened volatility. Major indices such as the S&P 500, Germany's DAX, and France's CAC 40 have experienced sharp fluctuations, reflecting uncertainty rather than fundamentals. This volatility is not random, it is structural. Investors are struggling to answer a simple but critical question: what happens next? Corporate earnings become increasingly difficult to forecast. Companies exposed to global supply chains face disruptions. Logistics costs rise. Delivery timelines become uncertain. At the same time, rising commodity prices, particularly energy, put pressure on profit margins. Businesses that once operated under stable cost assumptions now face unpredictable expenses. In this environment, investors reduce exposure to risk. Growth stocks, emerging market assets, and cyclical sectors become vulnerable. Capital begins to move, not toward opportunity, but toward safety. Even major financial institutions warn of potential corrections. In scenarios where the conflict escalates or persists, market declines of significant magnitude become increasingly plausible. This is the first phase of a systemic shock. When markets lose visibility, they lose confidence. Part 2. Energy, the core transmission channel. To understand the global impact of the conflict, one must focus on a single, central variable: energy. Iran is not just a geopolitical actor. It is a strategic player in global energy markets. At the heart of this system lies the Strait of Hormuz, a narrow maritime corridor through which nearly 20% of the world's oil supply passes. This is not just a statistic. It is a structural dependency. Any disruption in this corridor, whether physical or perceived, immediately affects global supply expectations. And in energy markets, expectations are everything. Since the onset of the conflict, oil prices have surged, in some cases exceeding $100 per barrel. Natural gas markets have also experienced increased volatility. But the implications go far beyond commodity trading. Energy is the foundation of modern economies. It powers transportation, manufacturing, agriculture, and logistics. When energy prices rise, the effects cascade across every sector. Production becomes more expensive, transportation costs increase, supply chains become less efficient. And ultimately, these costs are passed on to consumers. This is how a geopolitical event becomes an economic shock. Part 3. The inflationary spiral. Rising energy prices are one of the most powerful drivers of inflation. As companies face higher input costs, they are forced to adjust prices. Goods become more expensive. Services follow. Consumers in turn experience a decline in purchasing power. Food prices increase. Transportation becomes more costly. Everyday expenses rise. This creates a feedback loop. Higher costs, lower consumption, slower economic activity. But the challenge does not stop there. For central banks, this situation creates a complex and dangerous dilemma. Traditionally, central banks use interest rates to manage inflation and growth. If inflation rises, they increase interest rates to reduce demand. If growth slows, they lower rates to stimulate the economy. But in a supply shock scenario, both problems occur simultaneously. Inflation rises because of supply constraints. Growth slows because of reduced economic activity. This is known as stagflation, one of the most difficult macroeconomic environments to manage. It is a scenario where traditional policy tools become less effective and risks become more systemic. Part 4. Markets in reaction mode. Financial markets do not wait for certainty. They react to expectations, signals, and headlines. In times of geopolitical crisis, markets shift from analysis to reaction. Investors monitor developments in real time. Every statement, every escalation, every negotiation attempt becomes a trigger for market movement. This leads to increased volatility. Stock prices fluctuate rapidly. Commodities spike and correct. Currencies shift in response to capital flows. But beyond volatility, there is a deeper behavioral change. Investors begin to prioritize preservation over growth. Risk appetite declines, portfolio allocations shift, exposure to uncertainty is reduced. This is not panic, it is adaptation. Part 5. The flight to safe haven assets. In uncertain environments, capital seeks safety. This phenomenon is known as the flight to quality. Gold, historically considered a store of value, experiences increased demand. Investors view it as a hedge against inflation and geopolitical risk. The US dollar strengthens, not necessarily because of domestic strength, but because of its role as the world's reserve currency. US Treasury bonds attract capital due to their perceived stability and liquidity. This migration of capital has profound implications. It reduces liquidity in riskier markets. It increases volatility in equities. It reinforces global financial imbalances. The message is clear. In times of uncertainty, trust becomes the most valuable asset. Part 6. Emerging markets under pressure. While developed economies experience volatility, emerging markets face something more severe: vulnerability. Many emerging economies depend heavily on imported energy. As prices rise, their trade deficits widen. At the same time, capital flows out of these markets towards safer destinations. Local currencies weaken. Debt servicing costs increase, especially for countries with dollar-denominated debt. This creates a double pressure: external imbalance and internal instability. Governments face higher borrowing costs. Companies struggle to finance operations. Economic growth slows. The contrast between developed and emerging markets becomes more pronounced. While developed economies benefit from stronger institutions and diversified economies, emerging markets remain highly exposed to external shocks. Part 7. Strategic adaptation. In this environment, passive strategies are no longer sufficient. Companies and investors must adapt. Diversification becomes essential, not just across assets but across geographies and sectors. Exposure to high-risk regions must be carefully managed. Cost structures must be reviewed, particularly in industries sensitive to energy prices. Hedging strategies become critical to protect against currency and commodity volatility. But beyond technical adjustments, there is a strategic shift. Speed becomes a competitive advantage. Those who react quickly to geopolitical developments can mitigate losses and even identify opportunities. Because within every crisis, there are asymmetries. Defensive sectors such as healthcare and essential goods tend to perform better. Energy exporting countries benefit from higher prices. Alternative energy sectors gain momentum as economies seek to reduce dependency on unstable regions. The key is not just to survive the shock, but to understand it. Part 8. A new financial reality. The war involving Iran is not just a temporary disruption, it is a signal. A signal that the global financial system is entering a new phase, one characterized by higher uncertainty, greater interconnection, and increased sensitivity to geopolitical risk. Markets are no longer driven solely by economic fundamentals. They are shaped by political decisions, strategic conflicts, and global power dynamics. Energy, once considered a stable input, has returned as a central driver of economic volatility. Supply chains, once optimized for efficiency, are being reevaluated for resilience. Capital flows, once predictable, are becoming more reactive. In this new reality, traditional models must evolve. Conclusion: resilience in an uncertain world. The war in Iran illustrates a fundamental truth. The global economy is deeply interconnected and inherently fragile. A disruption in one region can trigger consequences across the entire system. For investors, companies, and policymakers, the lesson is clear. Anticipation is essential. Diversification is necessary. Risk management is critical. Because in a world defined by uncertainty, resilience becomes the ultimate competitive advantage. The question is no longer whether shocks will occur. The question is whether we are prepared to navigate them.